Welcome back to the deep dive. You know how we work here. We take that dense stack of sources you provide, articles, financials, white papers, and we distill the absolute core insights. And today we are not just looking at a major company. We're looking at the infrastructure that dictates the price of energy, the cost of borrowing, and really the future of global agriculture.
Yeah,
We are diving deep into the CME Group.
it's a big one.
It is.
Mhm.
This is the corporation that defines itself, and, the sources emphatically confirm it, as the world's largest operator of financial derivatives exchanges.
Right.
I mean, if global finance is an iceberg, the stock market is just the visible tip.
Yeah, that's a great way to put it.
The CME Group is the vast, submerged structure that supports the entire thing. It's an empire built on these strategic mergers, one that controls critical instruments spanning from, the interest rate complex in Chicago all the way to the price of a barrel of oil in New York. So our mission is to unpack these sources to understand the anatomy of this titan. How did this Chicago-based entity grow from rival trading pits into a monolithic global force? And maybe more importantly, what is the complex financial and technological plumbing that they operate? The plumbing that keeps the entire global system running.
A very big question.
We're going to trace its history of consolidation, analyze the crucial, often unseen function of its clearinghouse, and finally, look at the unique governance conflicts and the system-defining crisis they survived.
Sounds good.
Okay, let's unpack this.
And the scale here, it really demands attention. This isn't just a big player. It is an economic gravitational force.
Right.
When we examine the 2024 financial data you shared, the figures are genuinely staggering. I mean, we're looking at $6.13 billion in annual revenue,
Wow.
which then translates to massive profitability, $3.93 billion in operating income, and a net income of $3.48 billion. But I think the most telling figure is the asset base. The company holds $137.4 billion in total assets. This is the financial weight necessary to backstop global trade.
That's incredible.
And to understand that massive balance sheet, you have to understand the core product. CME Group operates exchanges for trading financial derivatives.
So futures, contracts, and options.
Exactly. Futures, contracts, and options. These aren't contracts for, the physical delivery of goods necessarily, but contracts to manage the price risk of 6 critical asset classes.
Okay, so what are they?
You've got interest rates, which is their largest segment, major equity indexes like the S&P 500 E-mini, foreign exchange or FX, energy, metals, and agricultural commodities.
The whole gamut.
The whole thing. And what's fascinating is the breadth.
Cool.
We're talking about an institution with roots stretching back over 170 years, yet they're still on the cutting edge. The sources confirm they're aggressively offering futures based on cryptocurrencies,
Of course.
proving that CME Group adapts its massive risk management machinery to the newest asset class. It shows incredible agility despite its age.
And the reason we emphasize empire is because the modern entity is a result of absorbing its largest historical competitors. It's not a single exchange.
No, not at all.
It's a powerhouse comprised of 4 heavy hitters operating under one roof. I've heard it called the derivatives quadruple threat.
That's a good name for it.
You have the original flagship exchanges,
Huh.
the Chicago Mercantile Exchange, or CME, and then the granddaddy, the Chicago Board of Trade, the CBOT.
Right.
But then you have the 2 heavyweights from the commodities world, both acquired to secure energy and metals markets, the New York Mercantile Exchange, NYMEX, and the Commodities Exchange, COMEX.
The New York contingent.
Exactly. And while the physical headquarters remain anchored in Chicago, the historic heart of U.S. derivatives, the operation is fundamentally global. It's a truly international undertaking.
Oh, absolutely.
The sources paint a picture of this vast physical network, confirming they maintain significant international offices, not just across the U.S., but everywhere. We're talking major financial hubs like London, Hong Kong, Singapore, Tokyo, some operational centers in places like Belfast, Bangalore, and Houston. That geographic spread is essential because risk is global, and the market needs a central clearing point that operates, on a 247 cycle.
Everything flows through their infrastructure.
Yeah.
It has to.
Right.
So to truly grasp the centralized power of CME Group today, you have to trace this deliberate path of consolidation. And we have to start with the oldest foundation, the Chicago Board of Trade.
BOT?
The CBOT, established way back in 1848.
Wow.
Yeah, this was a time when Chicago was just exploding as the rail and trade center of the American Midwest. Farmers needed protection against volatile grain prices, and the CBOT provided the mechanism standardized forward contracts, which, eventually evolved into modern futures.
And the CME came later.
The CME came later, founded in 1898. It initially focused on perishables, like butter and eggs, before it shifted its focus dramatically in the mid-20th century to financial futures.
Right, pioneering foreign exchange and interest rate futures.
Yeah, exactly. And these two entities, the CBOT and CME, they were historical rivals, competing fiercely from their adjacent legendary trading pits.
And that rivalry, it really set the stage for one of the most significant shifts in financial history. The transition from these private member-owned organizations to public, shareholder-driven corporations.
Huge change.
The CME initiated this change, completing its demutualization in 2000. And that's a term we can't just gloss over.
No, it's critical.
So what does demutualization actually mean for a financial utility?
Well, essentially, it's the transformation from a private, nonprofit, member-owned utility, where the members, the floor traders and brokers, own seats, and the exchange serve them into a joint stock company.
So instead of members running the show for their own trading access.
Right. The new entity, CME Group, became focused on maximizing profit for its public shareholders.
And this shift, it must have fundamentally changed the exchange's incentives.
Oh, completely. Before demutualization, the priority was reliable service, low fees for members, robust market function.
Right.
After the parent company's IPO in 2002, the incentive structure just flipped.
So the priority became generating massive, predictable revenue streams.
Exactly. By increasing efficiency, raising fees, and aggressively seeking market share through expansion and acquisitions. This strategic choice in 2000, driven by the desire to unlock capital and compete globally, is arguably the single most important decision that led to the CME Group we see today.
And that leads us to the defining event of the modern CME Group, the union of those two historical, sometimes bitter rivals. On July 12, 2007, the CME Group completed the $8 billion deal to merge with the holding company for the CBOT. This wasn't just a merger, it was the consolidation of Chicago financial power.
It was.
The strategic genius of this move lay in eliminating market fragmentation in the most critical financial segment, interest rate products.
Right. CME was the powerhouse for Eurodollar futures contracts based on short-term U.S. interest rates, while CBOT was the global standard for Treasury futures based on long-term U.S. government debt.
So by merging, the CME Group gained total dominance over
the entire U.S. yield curve.
Exactly.
No other entity could offer that kind of centralized, comprehensive interest rate risk management.
And the unified CME Group Incorporated was immediately branded as the world's largest financial market.
Yeah. And it became financially and strategically unassailable in its core markets. But like you said, that was just the launch pad.
Just the beginning.
For a relentless, systematic acquisition strategy designed to gain dominance in every major niche market segment.
So the next target was non-financial commodities.
Right. In 2008, they executed an $8.9 billion deal for the New York Mercantile Exchange, NYMEX, and the commodity exchange, COMEX.
And this was a colossal move.
It was. It instantly brought the benchmark contracts for crude oil, natural gas, gold, and silver under the CME umbrella. I mean, think about the global economy. The price of West Texas Intermediate, WTI crude oil, and the global benchmark for gold are set on those NYMEX COMEX exchanges.
So by acquiring them, CME Group centralized not just financial risks,
but global energy and metals pricing mechanisms, all under one roof.
And their appetite for consolidation didn't stop at energy or metals. It extended deeply into financial benchmarks. In 2010, CME Group struck an agreement to purchase 90% of Dow Jones & Company's financial indexes business,
including control over the formulation and licensing of the Dow Jones Industrial Average.
Now, this might seem like a smaller deal compared to the NYMEX acquisition, but it reveals a deep strategic insight.
Oh, absolutely.
Index licenses, the right to use a specific index, like the Dow, as the basis for a derivative product, are incredibly lucrative, predictable, and high-margin revenue streams.
Exactly. And they continue to refine this index strategy. In 2012, they contributed the Dow Jones indexes into a joint venture to form S&P Dow Jones Indices.
Okay.
They initially took a significant stake. And then, by 2013, after exercising some options, the CME Group increased its ownership interest in that joint venture to 27%.
So if we connect this to the bigger picture,
this M&A history shows a deliberate, calculated effort to centralize the major benchmarks the world trades against, whether it's the price of oil, the price of gold, or the movement of the U.S. stock market through the indices.
They want to own the intellectual property of risk management.
That's a perfect way to phrase it.
And they made sure their roots in agriculture were secure, too. In 2012, they spent $126 million to acquire the Kansas City Board of Trade, KCBOT.
Right.
Now, while the CBOT handles general grain contracts, the KCBOT was the dominant venue for the sale of hard red winter wheat.
A very specific, crucial strain of wheat used for bread flour that often trades differently than the softer red wheat of Chicago.
So by absorbing the KCBOT, CME Group cemented its control over virtually all major U.S. agricultural commodity futures. It ensured that, from the Chicago cornfields to the Kansas wheat plains, the mechanisms for hedging price risk flowed directly and solely through the CME Group architecture.
The centralization went global in 2018 with the massive $5.5 billion acquisition of the London-based Neckes Group.
Right, a huge international move.
And this signaled a major push not just into international market infrastructure, but specifically into the cash markets, the actual transactions between banks, not just futures.
So this is where the real money moves.
Exactly. Neckes was a giant in interbank electronic trading for foreign exchange and fixed income products. By buying NX, CME Group gained control of two key platforms, BrokerTec and EBS.
And they handle huge volumes of over-the-counter institutional trading.
Billions of dollars daily. It's all about securing the pipes where the biggest banks transact.
Before we move on to the operational side, let's just revisit a subtle but highly strategic transaction from 2016. The sources highlighted the sale of their massive suburban Chicago data center to Cyrus for $130 million.
Followed immediately by a leaseback transaction.
Right. For listeners who may not be familiar with that term, it's highly illustrative of modern corporate strategy.
It is.
CME Group sold the physical real estate and the infrastructure, generating a quick $130 million in cash. Then, they immediately signed a long-term lease agreement to continue using that exact same facility. Why should we care?
Well, because this showed a flexible and highly strategic approach to asset management.
They monetized a physical asset, moving it off their balance sheet, allowing them to redeploy that capital into core business functions like technology development or more M&A.
All without interrupting the 247 trading operation. It separates real estate risk from core market function. It's a move that says, we are a technology and financial services company, not a real estate holding company.
Yeah.
They were prioritizing capital efficiency and strategic investment over brick-and-mortar ownership. A very telling sign of their priorities heading into the 2020s.
Okay, so we've charted the empire's roots through a century of consolidation. Now let's go deep into the plumbing, the operational mechanisms that handle trillions of dollars in risk every day. And the engine of this massive enterprise is its electronic trading platform, CME Globex. Globex is where the action is. It's the high-speed network that allows customers in, approximately 150 countries to access the entire suite of CME Group contracts.
From agricultural futures to interest rate options.
All 24 hours a day, 6 days a week.
And when we talk about Globex, we have to talk about speed. We're talking milliseconds or even microseconds.
Unbelievable speeds.
The sources confirm that the operational architecture of Globex is designed for ultra-low latency. For high-frequency trading firms, HFTs, a 1 millisecond advantage can mean millions of dollars in profit.
And this is why concepts like co-location are so critical.
Exactly. Trading firms pay a premium to physically locate their computer servers right next to CME Group's own trading engine in those data centers, like the one they sold and leased back.
So it minimizes the physical distance the order has to travel,
giving them the fastest possible access to the market. The evolution from the 1848 CBOT pit, where a trader's voice and hand signals dictated speed, to Globex, where physical proximity to a server determines speed. It's just a dramatic reflection of how efficiency now drives financial market architecture.
That transition from human chalkboards to algorithms firing thousands of orders per second is staggering. But if Globex is the engine, then the safety mechanism, the absolute core of financial stability, is the clearinghouse.
CME Clearing.
This is the crucial, often unseen function. When we hear about market plumbing, CME Clearing is the essential element that prevents systemic collapse. And we really need to fully understand its function. It's far more complex than just settling trades.
Exactly. CME Clearing is the central counterparty, the CCP, to every single transaction it processes.
So what does that mean in practice?
Imagine this. When Trader A buys a contract from Trader B, CME Clearing immediately steps in and becomes the seller to A and the buyer to B. It becomes the legal counterparty to both sides of the trade.
So it isolates them from each other.
Precisely. It isolates the buyer and seller from one another's default risk. If Trader B suddenly goes bankrupt, defaults on their obligations, Trader A is still protected because their legal counterparty is the massive, solvent CME Clearing.
So it prevents a single failure from cascading through the entire system.
That's the crucial lesson learned from financial crises past. That's its entire purpose.
So how does CME Clearing actually manage that immense risk, given that they are guaranteeing trillions of dollars in obligations?
They do it primarily through a very sophisticated system of margining and collateralization.
Okay, and we need to distinguish between two key types of margin here. First, there's initial margin. This is the good faith deposit that a trader must post when opening a futures position. It's designed to cover the maximum expected loss that the position might incur over a short time horizon, usually one day, with a high degree of confidence.
And the second, which is perhaps more dynamic, is variation margin.
Okay.
This is calculated daily, sometimes multiple times a day, based on the current market movements. If the market moves against your position, you have to immediately post more variation margin.
Or your position will be liquidated.
Instantly. This constant daily mark-to-market process ensures that potential losses are covered in real time.
And the collateral they accept is highly regulated, I assume.
Or very. CME Clearing doesn't just take promises. They require high-quality, liquid assets. We're talking cash or treasury securities.
The safest stuff.
The safest stuff. This strict requirement ensures that when a default inevitably happens, the clearinghouse has immediate liquid access to funds to cover the failed obligations and keep the rest of the market operating smoothly.
And that's why they're part of CCP Global, that trade group for clearinghouses.
It reflects the universal recognition of their systemic importance. Absolutely.
That analysis really deepens the understanding of that $137 billion in assets they hold. It's not just profit, it's the bedrock of collateral that allows the entire global derivative system to function securely.
It has to be there.
Now let's look beyond the listed futures markets. Thanks to that NAX acquisition, CME Group also controls those two major cash market businesses, BrokerTec and EBS, and this gives them an even wider scope of influence.
It does. BrokerTec facilitates high-volume, dealer-to-dealer trading, primarily in fixed income markets, particularly U.S. Treasury bonds and repo agreements.
So this is the interbank market where large institutions lend and borrow against the most liquid assets in the world.
Yes, and by owning BrokerTec, CME Group gained insight and control over the very foundation of the global money market.
And then there's EBS.
Similarly, EBS provides foreign exchange spot trading. This is where banks swap huge quantities of currencies at the current real-time spot price. If you want to know where the dollar-euro exchange rate is being set minute by the largest financial players,
EBS is one of the key venues.
it is. So controlling BrokerTec and EBS places CME Group at the center of the underlying movements of debt and currency, which are the fundamental drivers for their derivatives business.
It creates a powerful synergy. They control the futures market where banks hedge risk.
And the underlying cash market, where banks execute the physical transactions. This combination provides unparalleled market visibility and pricing power.
And the centralization of function, it translates directly into record volumes. The sheer scale of risk being managed is just incredible.
It is.
The sources showed that in 2022, the exchanges reached a record average daily volume of 23.3 million contracts traded.
A 19% increase year over year. That demonstrates the growing complexity and volatility of global risk and the increasing reliance on CME Group as the universal solution for hedging.
And this volume growth demanded a massive strategic technological shift. This is where that Google partnership becomes so fascinating.
It really does. In 2021, CME Group announced a deep, long-term partnership with Google to move a huge amount of its infrastructure onto the public cloud.
And this was underscored by a significant $1 billion investment from Google into CME Group.
$1 billion. It's a monumental decision for a company that handles systemic risk. Moving the core plumbing of global finance to the cloud promises incredible scalability, better data analytics, and potentially faster access for global participants.
But it also raises fundamental questions about risk concentration, right?
It does. They are entrusting the stability of their platform to a single external technology provider. That strategic bet on cloud technology is being closely watched across the entire financial industry, and it reflects CME Group's commitment to staying ahead of the technological curve.
Their digital focus has certainly garnered recognition. The company has been named to the Forbes Blockchain 50 list for its exploration of distributed ledger technologies.
Acknowledging their forward-looking approach to data management.
Right. And winning the 2022 Waters Technologies Award for Best Market Data highlights another critical high-margin revenue stream. selling high-quality, real-time pricing information derived from their exchanges.
In the digital age, accurate, fast market data is almost as valuable as the trading itself.
So we've established the CME Group's technological and financial scale. Now we turn to the people and the unique structure that governs this massive enterprise. And this is where the history of those mergers truly clashes with the hyper-modern financial reality.
It gets complicated here.
Because the CME Group was built through the sequential acquisition and merger of several member-owned exchanges, it possesses a governance structure that is highly unusual for a publicly traded company.
It really is. It's a mechanism designed to protect the interests of the original members, even decades after the company went public.
And this legacy structure is most visible in the composition and the size of its board of directors.
Absolutely. In 2018, the board had 20 sitting directors. Now, if you look at the S&P 500 average, most large public companies aim for a lean board of, say, 10 or 11 directors for efficiency.
So 20 is huge.
It's massive. And CME Group size is a direct reflection of needing to accommodate representatives from the legacy CBOT, CME, NYMEX, and COMEX entities.
But the real power dynamic lies with the Class B shares.
This is the fascinating part. 6 of those 20 directors were elected exclusively by the holders of Class B shares.
And these shares were allocated to the original exchange members, the people who once owned seats on the trading floor.
Correct. And crucially, these Class B directors have special voting rights over specific aspects of the exchange's operations, like fee structures or rule changes related to the historical trading products.
So wait, if the Class A shareholders, the general public and institutional investors, own the company and its profits,
The Class B shareholders, this small group of legacy members, still hold a permanent, powerful veto or at least a significant non-dilutable voting block over how the exchanges actually operate.
it's a structural mechanism designed to preserve the culture and access rights of the pits in the digital era.
It is.
What's fascinating here is how this structure encapsulates that tension between legacy member ownership, which values access, and tradition.
And the modern public corporate structure, which is ruthlessly focused on maximizing quarterly shareholder value and executive compensation.
And that tension, it boiled over in 2018.
It did. The sources detail a move by the company management to streamline governance. They offer the holders of those Class B shares a significant financial incentive, about $10 million in total, to relinquish control over their 6 board seats.
The intent was clearly to consolidate power under the Class A shareholders and simplify strategic decision-making.
Particularly around M&A flexibility and technological upgrades that might impact the floor traders. But the outcome was a firm rejection.
They said no.
They said no. The Class B holders were unwilling to trade their long-term governance rights for a one-time cash payout. This rejection profoundly illustrates the enduring, legally entrenched influence of the original exchange members.
So even as the company races to the cloud and handles trillions in algorithmic trade,
The ghosts of the trading pick still have a seat at the table, actively influencing the corporate strategy.
that provides critical context for how complicated it is to run an organization of this scope. But if governance highlights the complexity of history, then our next topic highlights the incredible fragility and speed of the modern electronic system. Let's talk about the 2010 flash crash.
A huge event.
On May 6, 2010, the U.S. financial markets experienced this catastrophic, rapid, and temporary decline, a $1 trillion drop in valuation, followed by an immediate bounce back.
All within minutes.
All within minutes. It was a crisis that exposed the dangers of algorithmic speed and uncoordinated market safety mechanisms. And here's where it gets really interesting, because according to that 2014 CFTC report, CME Group's Globex platform was right at the center of the storm.
Right at the center. And it was due to the actions of a single, highly motivated individual. The primary cause was identified as the use of sophisticated spoofing algorithms deployed by a British financial trader named Navinder Singh Sarao.
And to understand the impact, you have to understand the mechanism, spoofing.
Right. Spoofing is a form of market manipulation where a trader places huge orders, what are known as iceberg orders, with no intention of ever letting them execute.
They just want to create a false impression in the market.
Exactly. They use these orders to trick high-frequency trading programs into moving prices, and then they cancel the original manipulative orders before they are ever filled.
And Sarao's target was the E-mini S&P 500 stock index futures contract, which trades on Globex.
The single most liquid stock index futures contract in the world. Its price moves are crucial because they dictate the pricing and direction for the underlying physical stocks on the NYSE and Nasdaq.
So he was targeting the nerve center.
The absolute nerve center. Sorrell used his algorithms to place sell orders for thousands of E-mini contracts, creating the artificial appearance of massive, overwhelming selling pressure on the market.
And the volume of his manipulation was just mind-boggling.
It was. The CFTC report found that Sorrell proceeded to replace or modify those deceptive orders an estimated 19,000 times before canceling them completely.
19,000 times.
All in a very short, volatile window. This algorithmic pressure destabilized the index futures market, causing HFTs to execute real selling orders, which then spilled over instantaneously into the physical equity markets, triggering that dramatic, chaotic decline.
It's incredible to think that a single trader operating from his home could precipitate a trillion-dollar panic. But what was critical and what informed the subsequent regulatory response was the immediate operational difference in how the various exchanges reacted.
That's the key analytical point. When the market spiked downward in a near-vertical dive, the CME's Globex platform reacted in an automated, pre-programmed fashion.
It did what it was supposed to do.
It initiated a volatility measure and temporarily halted trading in the affected contracts. Critically, the New York Stock Exchange, the venue for the underlying stocks, did not immediately halt trading.
Which created a dangerous disparity.
A huge one. The futures market, the key hedging mechanism, was frozen, but the underlying cash market kept plunging, exacerbating the chaos and the liquidity crisis. This failure of coordination was the major systemic flaw exposed by the flash crash.
And the long-term implication of that divergence was a complete overhaul of market safety protocols.
Had to be.
Regulators realized that in a high-speed, algorithm-driven world, fragmented responses are catastrophic. This led directly to the modern-day implementation of coordinated cross-market circuit breakers.
The new rules now require that if trading in a major index or security halts on one venue due to volatility, all major markets, futures, options, and stocks must halt simultaneously.
So everyone stops at the same time.
Everyone stops. This ensures that in moments of extreme stress, the market reacts consistently, preventing the kind of divergent, chaotic plunges witnessed on May 6, 2010. CME Group's automated response was, in many ways, vindicated, but the event forced unification across the entire U.S. trading landscape. Hashtag tag auto outro.
So if we synthesize this deep dive, the story of CME Group is fundamentally one of market centralization married to strategic technological dominance.
Right.
This company didn't just survive the transition from the pits to the screen, it drove it, growing from the 1848 roots of the CBOT through those massive defining mergers.
The $8 billion CBOT, the $8.9 billion NYMEX COMEX acquisition.
The $5.5 billion NX Group acquisition become the world's integrated platform for managing derivatives risk.
Yeah.
I think the biggest takeaways for you, having explored these sources, are centered on 3 points of unrivaled economic gravity. First, the company's sheer financial scale and profitability. That's $6.13 billion in revenue and its massive asset base. It just demonstrates its critical role in the global economy.
Second, its function as the central risk manager through CME Clearing is fundamentally irreplaceable, thanks to its sophisticated margining and collateral mechanisms.
Absolutely critical.
And third, its history isn't just archival. It is actively shaping its future, notably through the persistence of those legacy Class B shareholder controls, which dictate the speed and scope of corporate change.
So what does this all mean for the financial landscape you operate in? We've seen a company that is simultaneously shackled by, 19th century governance structures and yet completely essential to the hyper-modern, algorithm-driven world of global finance.
It's a real paradox.
We saw how the structural legacy of member ownership persists and how a single dramatic, isolated event, the spoofing algorithm of one trader, can permanently redefine market safety protocols across the globe. The journey from chalkboards to cloud computing is nearly complete. And given the magnitude of that 2021 partnership, where the technology giant Google invested $1 billion in CME Group specifically for its cloud strategy, a profound question hangs over the industry.
It really does.
How will the increasing integration of big tech influence the stability and governance of the world's largest derivatives market? Is moving this vital financial plumbing into the hands of a public cloud provider the necessary evolution for efficiency, or does centralizing control on that technological layer introduce new, systemic risks we haven't even encountered yet? That is something for you to mull or explore on your own.